Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. The government has shut down, and that means most government data publication has paused as well. The monthly CPI inflation report is delayed, and the monthly jobs report has suspended this month. So I'll plan to revisit those when they resume, and in the meantime, I'll start by checking in on the last publication out of the BLS before the shutdown, the Job Openings and Labor Turnover Survey, or JOLTS for short. So from the JOLTS, the first number to know this week is 3.2%. That was the hiring rate in August, meaning the share of the workforce that just got hired. It's around the lowest hiring rate since 2010, when the economy was just beginning to dust itself off and climb out of the Great Recession. It's one half of a simple summary of the economy that labor economists have been using for a couple of years now: slow to hire and slow to fire. Which brings me to the second number to know right now, 1.1%. That's the rate of layoffs and discharges, or broadly the firing rate to fit the rhyming scheme. It's not particularly high right now, even if it's up slightly from the essentially record low firing rate below 1% that we saw briefly in 2022. So putting that all together, what slow to hire, slow to fire means is that employers are essentially hunkering down, hanging on to their workers, but not interested in growing those payrolls quickly. For people with jobs, this means the economy feels essentially okay, not great, but okay. But for those without a job, it's proving unusually hard to break back into the workforce. So that is making it a terrible time to be unemployed and is gradually inflicting stress on the credit system and consumer spending. These are early signs of an economic slowdown, but not yet any indication of a recession. Now, turning to the housing market, we've got a familiar refrain this month. More inventory means buyers have gained more negotiating leverage relative to last year, although September likely was near the high water mark for the year with about 1.1 million active listings for the third month in a row. That is about 17% more than the same time last year. But importantly, inventory growth has passed an inflection point. For the fourth month in a row, the pace of growth of inventory has fallen yet again. Growth has now been roughly cut in half from the 32% annual growth rate seen in May. That means inventory is not on a runaway growth track toward a glut that would push prices down. Rather, the market is re-equilibrating as some sellers steer clear of a buyer's market or they delist after not getting a satisfactory offer. For buyers, it means conditions have moved in their favor, but they shouldn't count on that trend intensifying much further. Another helpful factor for buyers looking ahead is that borrowing costs are continuing to fall. The 10-year Treasury yield, which is a major benchmark that mortgage rates tend to track, plus about 2 points, has now dipped below 4% for the first time this year. That reflects a combination of lower expected economic growth and the resulting lower Fed funds rates expected over the next few years, as the Fed is expected to try to prevent a recession. So hand in hand with those lower Treasury yields, mortgage rates are moving back into their most favorable territory in 12 months, right around 6.25%. That represents major savings compared to the rates of around 7% to start the year. That's partly driven by investor expectations of interest rate cuts yet to come. But because those expectations are already factored into the low rates today, there's no guarantee that mortgage rates will fall further, even if or when the Fed continues cutting its overnight rate. Okay, that is all for this month. I hope we'll have more BLS data to talk about next month, and thanks as always for watching.